Well, another record-setting day on the worldwide stock markets. I mean, Brazil, the circuit breaker tripped twice today, which is crazy. We've had up to a 7% downtrend on the S&P 500. The down shed over 2,000 points. Now, I know for a lot of you out there, you are not watching this kind of technical analysis every single day or every morning. I mean, I would expect that a lot of my viewers are just passive investors, and that's what I've been doing for now 24 years. So I want to talk today about a whole bunch of things. I want to talk about average price returns. I want to talk about sectors that perform really well during recessions and sectors that get hit really hard during recessions, and what I'm doing strategically in order to keep my portfolio afloat. And as you guys know, I just recently retired, so this portfolio is my income right now. It is very, very important to me, and the pain is real. You know, I want you guys to know that we're all feeling it together. Hey everyone, welcome back to Drawbridge Finance. My name is Levi Woods. As always, I'm not a professional investor. I don't work in the finance industry. This is an opinion channel about money. Now today, I want to start talking specifically about pain because it is painful. I mean, this week, last week, the week before, we've been sitting here. I was traveling, just got back last weekend. Karine and I got back last weekend. So I was trading the market in the middle of the night, which was not great situation. Luckily for me, I didn't have a lot of option plays on, and that kind of kept my losses to a minimum in the options world. But my dividend portfolio is still the bulk of my investment strategy, and it has been for a very long time. And it is quite painful to look at the numbers because it doesn't matter how big your account is. If your account is $500 or $500,000 or $1 million, you know, a 10% loss, a 20% loss is it's a big loss. You know, now that said, I mean, we only actually capture those losses if we sell. So that's something really important to remember. I mean, as a dividend investor, we should be greedy when others are fearful. And what that means is that we should be buying stock when the prices are on sale, when the prices are a reasonable level. And today I want to show you guys a couple of charts and talk about whether or not these prices are at reasonable levels or not. Now, as you guys know, we've gone through this before. I started investing in 1996. So I actually saw a downturn in 2001. We saw the downturn again in 2008. I mean, we even saw a little bit of a quick downturn at the end of 2018. And I want to talk to you guys about that because the average return of the S&P 500 with inflation adjustment is only around 7%. So sometimes what happens is the market is actually overvalued and can be for a long time. So I want to take a look at the S&P 500 chart from the last 20 years. And I've pulled it up. I've got my usual moving averages on it. So what we're looking at we've got a 50-day moving average, a 10-day moving average, and a 200-day moving average. And you can see the green line is the 200-day moving average, and the red line is the 50-day moving average. And then the 10-day moving average is actually buried in the candlestick chart. You can't really see it, but it is in there. And so this is a chart going back to 2001 and up to present. Now today, the stock market's actually trading currently, it's open, and we're trading right around 252 levels. So it's actually dropped down today, and we're looking slightly lower than this 200-day trend line. We are in a recession. The stock market is falling more than it's gaining. So our economy is receding. Well, the US economy is receding, global economy is receding. And we have to think about how long this is going to last because they don't last forever. I mean, we know that there's companies all over the world, inflation continues to go up, and we have what's called positive drift. And so the stock market valuation will go up over time. That's just a matter of fact that will happen. And if we look at this 20-year chart, you can see that in 2008, we had a massive sell-off from the highs in late 2007 down to lows in early 2009. We had a massive reduction. And then there's, subsequent little blips in here, but we've had pretty well a straight up run. So I want to put a 7% trend line on here just to kind of show you guys how overinflated we were. So I've got it started back in 2001. If we were buying right at the top of 2001 before the dot-com bubble crash, that's the trend line. And this is a 7% compounded annually, and what the stock market average return would be. And of course, the market dropped quite low down into 2003. So if we move that trend line, and we were buying in 2003, like 17 years ago, the average price right now is actually above what the historical returns would be for the last 50 years. And we can see that that line, if as we move it along in time, that it is staying relatively, the market in general in the last 2-3 years has been above the trend line. Then if we go down into the 2008 recession, you can see that if we were buying at the bottom, this market has well exceeded an investor's account that started just 11 years ago. Even if we move this trend line up and say somebody started their portfolio like 5 years ago in 2015, and they were buying here at this level, a 7% return would have put them right around here. And that's about where the market is trading right now. Now, this is the average return. So in order for this to actually be an average, you have to imagine that this current stock price here that has dropped down would actually have to come down equidistant on the other side of the average trend line, which means we could have a potential substantial drop further than we are now. I mean, we could drop down easily to the 200 level to create this average trend line. If we were started investing like 2 years ago, the 250 is actually below our average price or our average expected return. So anybody that's out there that has just started investing in the last 2 years, you are probably feeling a lot of pain right now because the portfolio value has dropped substantially, and you are probably looking at a situation where your portfolio is worth less than you paid for it. If you bought any time in the last year, even worse. But I'm here to tell you that over time, this market is going to be fine, and we cannot panic about these things. It's like the worst thing that we can do. We have to just trust that the market value is down now, and it will recover, and it will come back to a good level. Now, one of the things I love about these charts in general right now is that this drop is so dramatic. It's really, really fast. Usually what happens is our recovery is quicker when there's a really fast drop. If we look back at the end of 2018, I don't know if you guys remember, but if you concentrate on this part of the chart, we had this massive sell-off in December, and then it rebounded right back up in January and February. And it was actually quite nice because it gave us an opportunity to buy down at these 200-day moving average levels. It just kind of came and touched it. And you can see today we've actually broken through that. Now, I am not saying by any stretch that I am like running out and buying a ton of stocks. I actually don't think we've seen the bottom of this. I think that the virus is, boy, I can't really say that. I probably have to blip that out. But I think that the global virus that's going on right now is actually crushing the stock market down quite a lot. And there's a bit of overreaction happening because a lot of these companies, there's no way that they've lost like 50 or 70% of their value. And some of the companies have. You know, in 2008, when we look at it, it actually kind of came down in these tiers, and it came down a bunch before this massive sell-off. And then it took a while to recover. So generally speaking, the faster the fall happens, the faster the recovery. So I'm actually quite thankful that it's happening this fast because there's nothing worse than waiting the whole year. Like in 2008, the pain was just horrible. The whole year we were just like watching the market go slower and lower and slower. And it was just like, it was an awful situation. But if we do see a quick recovery, then at least it lessens the amount of time that we've been in pain. Another thing to consider is that if you have been investing only 1 or 2 years, your likelihood is that your account is relatively small. I mean, I like to think about the amount of money that my portfolio value has dropped in terms of like my working capacity. You know, if I want to work and make, say, like $80,000 a year, then how much has my portfolio dropped relatively to that? You know, if my portfolio has dropped to half, but it started at $10,000 and went to $5,000, I mean, $5,000 really is not that big of amount of money in the grand scheme of things. It might feel like it now, but later in life, when you realize you have like $1 million portfolio, having a $5,000 loss is relatively little comparatively. So over time, your portfolio will grow and it will become bigger amounts. And that's when these events actually, you would think cause a lot more pain, but at the same time, you just kind of go, well, it's just part of the investing and it's part of the roller coaster ride that we're on. So we have to remember to be calm during all situations like this. Now, with that being said, I also have to really remind myself that I can't concentrate on thinking about selling. There's a lot of times where you think, okay, well, if I sell now, the stock's going to continue to drop. And it's really, really difficult to time the market. Now, for those of you who are patrons of mine, you know that I have been doing a little bit of selling, and I made a post about it yesterday. Now, you have to remember, I have some fairly large positions and I'm selling off just a portion. Some of the stocks that I was selling yesterday, I was selling 1/10 of my holdings. So it's like I'm just moving a little bit around just to kind of bring the percentage of each stock into the right place for my portfolio. So they're more of adjustment trades than anything. I certainly am not liquidating giant portions of my account. The trades that I made yesterday accounted for less than 1% of my total net worth. So even though I am selling some stock right now, I'm not selling en masse because I know that it's really difficult to time the bottom. And what I don't want to do is sell and then have the stock bounce back up and miss out on that up opportunity. The reason I'm a dividend investor is because I collect dividends every month. And what I need to do is concentrate on buying. So I have to take those dividends and I have to allocate them correctly. So that's what I'm doing right now is I'm trying to figure out when I'm going to be putting my entry points in rather than considering selling at all. And it's one of the reasons why I'm thankful to be a dividend investor. I mean, my dividends have not yet reduced. In 2008, when we went through this, my portfolio value dropped 46%. My dividend payouts only reduced by 16%. So it was a really quick recovery for my dividends, my monthly income stream to actually get back up to a proper level after the bottom in 2008. And I never sold then either. I just ride it out. The value of the portfolio drops, but then it recovers. But the dividend value or the dividend payout stays the same. And that's why I'm a dividend investor. Now, I also want to talk a little bit about sectors that perform well during recessions and sectors that don't perform very well. Now, because it's important to kind of have a strategy going forward. Like, what sectors are we looking at that are going to do the best during the recession, and then what sectors are going to do well when the recession starts to end and starts to go back up. Obviously, the tech sector gets hit extremely hard always. These are speculative plays, and it's just the nature of technology. So, it's one of those things. I have some Amazon stock. I play Apple options. I've got some Google stock. Amazon and Google are kind of my big exposure to tech, and we've seen the biggest reductions in those in the percentage of my portfolio. But I also have like a lot of utility stocks, and utilities do extremely well during recessions. Let's pull up a couple of charts and just take a look at a couple things. I'm going to show you Fortis today. Let's look at 5 years and say, okay, say I was an investor back in 2016. Like, what level would I be buying at? In 2016, I would probably be buying somewhere in here between like the $28 mark and the $32 mark. And then I would have been collecting a dividend of around 4% during that time, or from then. So if we look at this, it's kind of run up, and right now with this massive sell-off, it has sold off quite a lot. It's kind of come down as low as $32.50, and right now it's trading at $34.15. It's down 4.5% today. But it's still above where we would have been purchasing just 5 or 6 years ago. Now, if we were buying at the high points, if we were not really paying attention and we were buying when these prices were above the moving averages, we would be down right now. And that's why it's been so difficult in the last year. In 2019, you can see this candlestick chart. The whole time, the stock was trading above its moving day averages. Even here, when it dropped back down, it didn't even come down to the 50-day moving average. It didn't even come close to the 200-day moving average. Now that we've actually seen this recession starting and we're seeing these bigger drops, all of a sudden we're looking at buying opportunity finally. And we haven't had this. The last time was in December of 2018, and it was just for a day. It just popped down into it. Other than that, the only time that were good entry points were below this green line, and it's not very frequent in the last couple years. So now for people that have just started out investing, if you're just in the last 2 years, I mean, this is going to hurt a lot because you would have been purchasing up at these levels here, and the stock now is trading a lot lower. You have to remember that we're going to recover. The stock price will recover. It will maybe not be up right at $40 right away. It might take a while, but it'll eventually get there. And in the meantime, we can collect the dividend, and we use that dividend to buy other stocks. If we've been investing in Fortis for the last 10 years, we're still well above any dollar cost average purchase. Now, for dollar cost averaging, what you're doing is you're buying incrementally all of the time. Every paycheck, you're putting a little bit more in. And that's one of the beauties about being alive today, is that we can do that. We have accounts like Webull and Wealth Simple Trade where we can purchase one stock for free. It's a great time to be an investor. I mean, when I was a kid, when I started, it was massively expensive. I would pay $100 for a trade in fees, and now $0. It's kind of crazy where we are now. Now, there's some sectors that get hit extremely hard, and one of them is banking. What happens is the interest rates generally lower during a recession. While that's great for us as a consumer because we can borrow at really low rates, it is not actually good for the banks, and so the banks get hit quite hard. Let's take a look at CIBC. So I'm going to pull it up on the New York Stock Exchange. CIBC trades on both the New York Stock Exchange and the Canadian one, so that's why I'm using it as an example. During 2016, where we were able to buy a utility like Fortis, and the level was currently above that level from 5 years ago, CIBC is trading way down here. It's trading at 53.39. It's had a reduction of 14% just today, which is massive. And it means that at no point in the last 5 years were you able to purchase this stock and have it worth more today, which is quite unfortunate. So still collecting a nice juicy dividend. In fact, because the price is so low, if somebody was to buy now, the dividend yield is actually quite high. So it's around 6%, which is incredible. Now, is this buying opportunity? I'm a little bit leery to be jumping into bank stocks right now. In fact, yesterday, as I mentioned before, I was actually selling some. Now, if you're interested in following all of my trades, you can check out my Patreon account. I'll put the link here or put it down in the description. You can click over there and you can follow all of my trades so you can see what I'm buying or selling on any given day. Again, looking at these moving averages, we would want to be purchasing these stocks when it's below the moving averages. So just in the last couple of days, it's kind of come into that range. And I think there is buying opportunity ahead. I just don't think it's quite yet. So if you haven't subscribed to the channel, you probably should. And remember to turn on the notifications bell, because I have a feeling with all of the buying that's going to be coming up in the coming months, I'm going to be live streaming some of my trades because I just won't be able to get the opportunity out to you guys quickly enough without doing a live broadcast. So if you have your notifications bell on, you will know exactly when I am broadcasting and saying exactly what I'm doing with any particular stock coming forward, because I think there is going to be a lot of opportunity. Now, that being said, cash is king right now. If I'm thinking about ways to make more cash, because I know that in the next month, 2 months, 4 months, 5 months, this year in general, if I have more cash, then I'm going to be able to deploy that cash into new investments, which are going to rally back up and make me a substantial amount of money. And that's what this channel is all about, is making money. So that's what we're here to do, is get rich together. If you guys are interested in joining along, click that subscribe button, click the like button, and let's get rich together. Talk soon. Thanks so much for watching.